Tesla's stock has tumbled 8%, pushing its market value below $1 trillion for the first time since November.
For over a decade, Tesla reigned as the undisputed leader in electric vehicles. It set the benchmark, shaped the industry, and left competitors in the dust. But now the tides are turning, competition is heating up, challenges are mounting, and Elon Musk is under pressure to adapt. So, what's going wrong? What does this mean for the future of EVs? And can Tesla reclaim its dominance before it's too late? From pricing missteps and shifting market demands to China's rapid expansion, Tesla's grip on the industry is slipping. Stick around, because what happens next could redefine the future of electric cars forever. For the first time ever, Tesla is no longer the world's top-selling electric vehicle brand. Chinese automaker BYD has surged ahead, delivering over 526,000 vehicles compared to Tesla's 484,000. But this isn't just a fluke. It's the result of years of rising competition, strategic missteps, and shifting market trends. While Tesla wrestled with production delays, supply chain struggles, and pricing miscalculations, BYD was methodically executing a long-term strategy. Tesla's decline wasn't caused by one major failure, but by a series of cracks that had been forming for years, cracks that have now weakened its grip on the market. The real question isn't just how this happened, but whether Tesla can bounce back. The warning signs were there: a false sense of security, a slower pace of innovation, and increasing quality control issues. Once untouchable, Tesla assumed its technology and brand power would always keep it ahead. But now, the competition has caught up, and the EV landscape may never be the same again. For years, the Model S, Model 3, and Model Y dominated the EV market, but Tesla's failure to refresh its lineup left customers waiting for updates that never came. Meanwhile, competitors like BYD, Volkswagen, Hyundai, and Ford introduced new models at a rapid pace, offering better interiors, more variety, and competitive pricing. Tesla's struggles didn't stop there. Missed delivery targets frustrated customers, long wait times damaged trust, and inconsistent build quality led to complaints about panel gaps, software glitches, and unreliable driver assist features. Once known for cutting-edge engineering, Tesla's reputation began to fade. Another major misstep was Tesla's pricing strategy. The company assumed buyers would continue paying premium prices, even as more affordable, high-quality EVs entered the market. While competitors like BYD optimized production costs and offered budget-friendly alternatives, Tesla was slow to react. By the time it slashed prices, the damage was already done. Perhaps Tesla's biggest mistake was assuming its brand loyalty would keep customers from leaving. But the EV market was evolving fast, and buyers wanted more affordable options. While Tesla rested on its reputation, BYD was executing a plan that would change the industry forever. Tesla underestimated BYD. Western automakers dismissed Chinese EV brands as low quality, and even Elon Musk once laughed off BYD as a non-threat. But while Tesla focused on luxury and software, BYD was playing a different game, one Tesla wasn't prepared for. Instead of chasing high-end buyers, BYD streamlined production, cut costs, and built an efficient supply chain that Tesla couldn't match. With strong government support in China, BYD sold EVs at lower prices while maintaining profitability. One of BYD's biggest advantages was battery production. Unlike Tesla, which relied on suppliers, BYD made its own batteries, ensuring lower costs and a more stable supply chain. This allowed BYD to expand rapidly, dominating emerging markets and even pushing into Tesla's strongholds. By the end of 2023, BYD had completely reshaped the EV industry. Tesla was no longer the only name in the game. But it wasn't just BYD's rise that hurt Tesla, it was also Tesla's own mistakes. In early 2023, Tesla launched a price war, slashing prices by over 20% to boost sales. At first it worked, but the long-term consequences were severe. The aggressive cuts devalued Tesla's brand, angered existing customers, and wiped out profit margins. Buyers who paid full price saw their cars lose value overnight, leading to cancelled orders and lawsuits over unfair pricing tactics. Worst of all, the price war didn't eliminate competition. Instead, it exposed Tesla's vulnerabilities, proving that the company was no longer the unstoppable force it once was. Now, the question isn't just how Tesla lost its lead, but whether it can ever reclaim it. Instead of crushing the competition, Tesla's price war backfired. BYD and other automakers responded with their own price cuts, neutralizing Tesla's advantage. Unlike Tesla, which was already struggling with rising production costs, BYD managed to lower prices while maintaining profitability. In the end, Tesla's aggressive pricing strategy exposed a bigger issue. It was no longer leading the EV industry. Instead of setting the pace, Tesla was reacting to competitors. But pricing wasn't Tesla's only Achilles heel. A much deeper problem was brewing: its supply chain. Tesla's gigafactories were supposed to be the foundation of its EV empire. By controlling its own high-tech production facilities, the company aimed to cut costs, boost efficiency, and maintain quality. The goal was clear: eliminate reliance on suppliers, mass-produce vehicles at an unmatched scale, and create an infrastructure no competitor could replicate. For a time, the strategy worked. Tesla revolutionized EV manufacturing, setting new benchmarks for automation and battery integration. However, as the industry evolved and global supply chains became strained, Tesla's biggest strength turned into its greatest weakness. Gigafactories require a steady stream of raw materials, and when the supply chain crisis hit, Tesla's centralized model became a bottleneck instead of an advantage. Shortages of chips, lithium, and other crucial materials caused major delays, forcing the company to slash production targets. Meanwhile, competitors like BYD and Hyundai, which had more flexible production models, adapted faster and kept their factories running. To make matters worse, Tesla's rapid expansion added new challenges. Gigafactories in Germany and Texas launched before they were fully optimized, leading to inefficiencies and production headaches. What was once a well-oiled machine was now struggling to keep up. Reports of production inconsistencies, logistical challenges, and labor disputes further strained Tesla's ability to keep up with demand. Instead of solving its manufacturing issues, these new gigafactories introduced fresh complications, slowing output, increasing costs, and creating bottlenecks. At this point, Tesla was no longer the agile disruptor it once was. It had started to resemble a traditional automaker, bogged down by an inflexible supply chain and rising operational inefficiencies. But supply issues were just the beginning. As Tesla scrambled to fix production delays, a deeper vulnerability became clear: its over-reliance on third-party suppliers. Unlike BYD, which produces its own batteries in-house, Tesla depended on external suppliers like Panasonic, LG, and CATL for its battery cells. This made Tesla highly vulnerable to supply chain disruptions, cost fluctuations, and shortages. As global demand for EV batteries surged, Tesla found itself competing with other automakers for limited resources. Battery prices skyrocketed, squeezing Tesla's margins and causing further delays. Meanwhile, companies like Ford, Volkswagen, and Hyundai aggressively invested in their own battery production, reducing their dependence on third-party suppliers. Tesla's supply chain troubles were compounded by its reliance on China for critical raw materials. Over 70% of the world's lithium processing occurs in China, making it difficult for Tesla to secure a stable, cost-effective supply without exposure to geopolitical risks. As tensions between the US and China escalated, Tesla's dependence on Chinese suppliers became increasingly problematic, threatening its long-term cost stability. Adding to the challenge, Tesla's vertically integrated approach meant that any disruption in one part of the supply chain could ripple through the entire production process. Unlike BYD, which had multiple battery production facilities, Tesla was locked into contracts with a handful of key suppliers, limiting its flexibility when shortages hit. While competitors diversified their supply chains, Tesla remained vulnerable to shifting trade policies, raw material price hikes, and logistical setbacks. But Tesla's challenges weren't just about supply chains. They exposed an even bigger issue: its fading technological edge. Tesla's autopilot and full self-driving (FSD) software was once hailed as the future of autonomous driving. Elon Musk frequently promised that Tesla vehicles would soon be fully autonomous, eliminating the need for human drivers. For years, Tesla's self-driving features gave it a competitive advantage, attracting tech-savvy buyers and positioning it as a leader in innovation. However, the reality failed to match the hype. regulatory pushback, safety concerns, and high-profile crashes led to mounting lawsuits and government investigations. Instead of a self-driving revolution, Tesla found itself facing legal battles and increased scrutiny. Meanwhile, automakers like Mercedes-Benz, BMW, and even Ford were developing advanced driver assistance systems that were proving to be more reliable and compliant with regulatory standards. Tesla's dominance in the EV space was no longer guaranteed. The competition had caught up, and in many areas, had surpassed it. In the US, the National Highway Traffic Safety Administration, NHTSA, launched multiple investigations into Tesla's self-driving failures, further tarnishing its reputation. Meanwhile, companies like Waymo, Cruise, and even BYD were making rapid advancements in autonomous driving technology. Unlike Tesla, which relied on a camera-based system, Waymo and Cruise leveraged LiDAR and radar, which proved to be more reliable in real-world conditions. As a result, Tesla's once groundbreaking self-driving software now seemed outdated. Compounding the issue, Tesla's over-the-air software updates frequently introduced new glitches, leading to unexpected braking, phantom stops, and erratic lane changes. These malfunctions made headlines, raising serious safety concerns and eroding consumer trust. Once the clear leader in autonomous vehicle technology, Tesla was now struggling to keep pace. The company had prioritized bold promises over delivering meaningful improvements, and competitors were quickly closing the gap. But Tesla's challenges extended beyond software. It was also losing ground in new vehicle development, frustrating customers with an aging lineup. Delayed Tesla models. When Tesla launched the Model S, it redefined what an electric vehicle could be. The Model 3 followed, making EVs more accessible to the mass market. However, Tesla has not significantly updated its core lineup in years, and customers are starting to notice. While competitors like BYD, Volkswagen, and Hyundai continue to introduce fresh models with improved technology, Tesla has struggled to deliver on its long-standing promises. The Cybertruck, Roadster, and the long-awaited Model 2 have all faced repeated delays, leaving potential buyers frustrated. The Cybertruck, first announced in 2019, was expected to disrupt the pickup market. Yet production setbacks, design overhauls, and supply chain challenges have kept it in limbo for years. Meanwhile, the affordable Model 2, which was supposed to dominate the entry-level EV market, remains nowhere in sight. As Tesla lags behind in both software and vehicle development, its once unshakable dominance in the EV industry is looking more uncertain than ever. Tesla's aging lineup. Meanwhile, Tesla's existing lineup is beginning to show its age. The Model 3 and Model Y, which still account for the majority of Tesla's sales, have only received minor updates since their launch. Customers seeking modern interiors, new features, and more affordable options are turning to rivals that offer greater variety and innovation. This stagnation presents a major risk. In the fast-moving auto industry, staying ahead requires continuous evolution, and Tesla is starting to lag. Emerging competitors like Rivian, Lucid, and NIO are introducing fresh designs and cutting-edge technology, challenging Tesla's once unquestioned dominance. Just a few years ago, these brands were barely a threat. Now they're setting new standards in the EV space. The issue is clear. Tesla is no longer leading the industry. A lack of new models, ongoing supply chain difficulties, and declining technological leadership are putting the company at a disadvantage in the increasingly competitive EV race. But Tesla's struggles didn't stop at production delays and innovation setbacks. There was another major distraction that investors couldn't ignore. Elon Musk himself. The Twitter distraction. Elon Musk's bold leadership and ambitious promises helped transform Tesla into more than just an automaker. It became a movement. But in 2022, Musk made a decision that stunned the business world. He purchased Twitter for a staggering $44 billion, diverting his attention from Tesla at the worst possible time. Investors were immediately alarmed. As competition in the EV market reached its peak, Musk was preoccupied with his new social media empire. He spent months restructuring Twitter, firing executives, rolling out controversial policies, and engaging in heated online debates, none of which had anything to do with Tesla's future. Tesla's stock collapse and brand damage. While Musk was focused on Twitter, Tesla's stock took a nosedive. losing billions in market value as investors grew increasingly concerned about his divided attention. But it wasn't just Wall Street that noticed. Tesla employees, already under immense pressure due to production issues and supply chain disruptions, felt abandoned by their leader. Musk's hands-on leadership had once been a key advantage, driving Tesla's innovation and efficiency. Now, as the company faced massive production bottlenecks, pricing instability, and intensifying competition, his absence was felt across the board. Customers also started to sense the shift. Tesla's brand had always been closely tied to Musk, but as his public persona became more polarizing, many buyers began reconsidering their loyalty. Order cancellations increased, and frustrated customers took to social media to complain about declining service quality, delayed vehicle updates, and the lack of fresh models. Tesla's competitors didn't hesitate to take advantage. While Musk was preoccupied with Twitter, companies like BYD, Hyundai, and Volkswagen aggressively expanded their EV lineups, seizing the opportunity to gain market share. By the time Musk turned his focus back to Tesla, the damage was already done. But his personal distractions were only part of the problem. Tesla now faced an even greater challenge: China's dominance in the EV industry. China's EV takeover. Tesla's early success was built on its technological edge and first-mover advantage, but in the background, China was quietly building an EV empire. Today, China controls 70% of global battery production and dominates key EV supply chains. While Tesla was revolutionizing electric cars, China was securing the raw materials, manufacturing capacity, and government backing needed to take over the industry. Companies like BYD, NIO, and XPeng have grown at an astonishing rate, flooding the market with high-quality, affordable EVs. Their biggest advantage? Vertical integration. Unlike Tesla, which still relies on third-party suppliers for batteries, these Chinese automakers control everything from battery production to final assembly, significantly lowering costs. BYD, in particular, produces its own batteries, giving it a major edge over Tesla, which is still dependent on external manufacturers. Government support has played a crucial role in China's EV dominance. Generous subsidies, incentives for local buyers, and massive infrastructure investments have allowed Chinese automakers to expand at a pace Western companies simply can't match. While Tesla remains one of the top-selling brands in China, maintaining that position is becoming increasingly difficult. With rising trade restrictions, regulatory hurdles, and fierce competition from Chinese brands, Tesla's grip on its most important international market is slipping. Tesla's over-reliance on Chinese supply chains is another looming threat. Despite operating a gigafactory in Shanghai, the company still depends heavily on Chinese suppliers for batteries, semiconductors, and raw materials. This puts Tesla in a vulnerable position. Any geopolitical conflict, supply chain disruption, or policy shift by the Chinese government could severely impact production and profitability. Chinese automakers expand into Tesla's territory. As Tesla struggles to maintain its dominance, Chinese automakers are aggressively expanding into key markets, including Europe and North America. With lower production costs and rapidly advancing technology, brands like BYD are offering more value for money, forcing Tesla to cut prices just to stay competitive, further squeezing its profit margins. While China's EV surge presents a major challenge, another competitor is closing in from a different direction: legacy automakers. The rise of legacy automakers. Once considered slow to adapt, traditional automakers like Ford, Volkswagen, and Hyundai have finally caught up in the EV race. Initially seen as lagging behind Tesla's innovation, these brands have now invested billions in battery technology, EV research, and large-scale production capacity. As a result, they are producing some of the most competitive electric vehicles on the market today. Ford's Mustang Mach-E and F-150 Lightning have proven to be massive hits, bringing Tesla-like innovation to mainstream buyers. Volkswagen, leveraging its global manufacturing infrastructure, has rapidly scaled up its EV production with the ID series. Meanwhile, Hyundai and Kia have introduced models like the Ioniq 5 and EV6, which have been praised for their long range, advanced design, and ultra-fast charging, outperforming some Tesla models in key areas. Tesla's early advantages in range and performance are no longer unique. Legacy automakers now offer similar or better battery efficiency, faster charging times, and more premium features. all often at a lower price. Another growing issue for Tesla is customer service and reliability. While Tesla relies on a direct-to-consumer sales model with limited service centers, legacy brands have well-established dealership networks, making repairs, servicing, and warranties more accessible. Many EV buyers who once saw Tesla as the only option are now turning to trusted brands that offer better long-term support and ownership experiences. Tesla's aging lineup, a growing concern. As competitors roll out new models each year, Tesla's lineup is beginning to show its age. The Model 3 and Model Y still account for the majority of Tesla's sales, but with minimal design changes since their launch, they're starting to feel outdated, while automakers like Volkswagen and Hyundai are introducing fresh designs and cutting-edge technology. Tesla has relied heavily on software updates to keep its vehicles relevant. With mounting competition and internal struggles, the question remains, what's next for Tesla? Can it maintain its dominance in the EV market? The road to survival. Despite its challenges, Tesla isn't out of the game yet. It still holds a strong position in brand recognition, charging infrastructure, and software innovation. However, if it wants to stay ahead, it must act fast. There are 3 key areas Tesla needs to address immediately. 1. Expand the vehicle lineup. Tesla cannot rely on the same few models forever. To stay competitive, it must introduce new vehicles at different price points, including the long-promised affordable Model 2. 2. Fix supply chain vulnerabilities. Tesla needs to reduce its dependence on Chinese suppliers by diversifying production, ramping up battery manufacturing, and securing its own raw material sources. 3. Refocus on innovation. To regain its technological edge, Tesla must deliver on its promises, particularly with 4680 battery technology, self-driving advancements, and faster charging speeds. The next few years will determine Tesla's fate. If the company can overcome these hurdles, it could reclaim its lead and continue shaping the future of electric vehicles. But if it fails to adapt, Tesla risks being overtaken by competitors like BYD, Volkswagen, Hyundai, and the next wave of EV innovators. History's lessons. Can Tesla avoid the same fate? Tesla is facing a turning point. Many dominant automakers have fallen before, failing to adapt to industry shifts. What can Tesla learn from history? The General Motors EV1, a missed opportunity. In the late 1990s, General Motors introduced the EV1, a groundbreaking electric vehicle that could have reshaped the auto industry. With futuristic design and strong consumer interest, it was a glimpse into an all-electric future. However, GM abandoned the project in the early 2000s, citing high production costs, limited profitability, and a lack of charging infrastructure. Instead of refining and expanding EV development, GM recalled and crushed nearly all EV1s, throwing away its early lead. This miscalculation left a massive gap in the market, one that Tesla later filled. By proving that EVs could be desirable, technologically advanced, and profitable, Tesla became the industry's new leader. But now, history might be repeating itself, with Tesla at risk of falling into the same trap. Like GM in the 90s, Tesla was once the undisputed pioneer. However, its lead is shrinking as competitors introduce more affordable, technologically advanced EVs. If Tesla fails to expand its lineup, improve production efficiency, and stay ahead in innovation, it could face the same fate as GM's EV1, left behind while others take control of the market. Ford's Model T, the dangers of stagnation. In the early 1920s, Ford was the world's most powerful automaker, controlling over 50% of the US car market. The Model T revolutionized transportation with its affordability, reliability, and mass production. But by the 1930s, Ford's dominance crumbled. The reason? Failure to evolve. While competitors like General Motors and Chrysler introduced new designs, better comfort, and multiple model choices, Ford clung to the Model T for far too long. The company assumed its early success would last forever, ignoring shifting consumer demands. As a result, General Motors overtook Ford in sales, and the once unbeatable Model T became obsolete. Tesla faces a similar challenge today. While it revolutionized the EV market, its core lineup has barely changed in years. The Model 3 and Model Y still dominate sales, while competitors roll out fresh designs with better interiors, advanced tech, and lower prices. Automakers like BYD, Volkswagen, and Hyundai are rapidly gaining ground, offering superior value and more choices. If Tesla follows Ford's old strategy, sticking to a limited product line, delaying innovation, and failing to diversify, it could suffer the same fate. The Cybertruck and Roadster delays have already frustrated customers. Without fresh designs, improved interiors, and more affordable models, Tesla risks losing its competitive edge. Is this the end of Tesla's dominance? Tesla is still a major force in the EV industry, but the days of unchallenged dominance are over. BYD has already outsold Tesla, legacy automakers are catching up, and new startups are filling gaps Tesla once controlled. Tesla's biggest challenge isn't just competition, it's its own ability to adapt. To stay ahead, it must 1. Expand its lineup with affordable and diverse models, including the long-promised Model 2. 2. Fix production inefficiencies to prevent supply chain disruptions. 3. Advance self-driving technology to stay ahead of competitors. 4. Improve pricing strategies to compete with BYD and Volkswagen. Tesla still has a strong brand, the best charging infrastructure and technological expertise. But it can no longer rely on past success alone. If it fails to evolve, it risks becoming just another automaker struggling to stay relevant, just like Ford in the 1930s or General Motors in the early 2000s. What do you think? Can Tesla reclaim its lead, or is it destined to lose ground in the global EV battle? Drop your thoughts in the comments.